Hello and welcome to the Airlie Australian Share Fund quarterly update. My name is Mark Burgess and I'm pleased to be joined by Portfolio Manager of the strategy, Emma Fisher. Welcome, Emma.
Thanks for having me.
2025, towards the end of it, we saw some massive changes in the market. We saw tech stocks sell off. We saw even CBA have a hiccup in November. What do you make of that and how have your portfolio positioned for that?
Yeah, so the December quarter was interesting. I think, the really big news story there was resources absolutely ripped. So the sector was up 13% over the quarter. And initially we had thought that any resources rally would be funded through banks. And, we've made no secret of our views of banks over the years where we've been absolutely wrong. The big four, their share prices are up 50% over the last 2 years. But if you actually look at their earnings, they're down 4% as a group over the last 2 years. So it's not been earnings driven, it's been a PE re-rate. So we thought they were absolute sitting ducks to fund any resources rally. And if you look historically, you do see this back and forth between the banking sector and the resources sector. The AFR headline yesterday was about BHP taking the mantle from CBA as Australia's largest stock, which has happened a lot over history. But actually over the quarter, the banks have held up all right. As you mentioned, CBA has started to come back. It's off about 20% from its highs in June. But there has been a rotation into the cheaper banks. ANZ, for example, is up 30% for the year as the market has really bought this cost out story that the new CEO has announced to the market. Now, we are more skeptical, and we're skeptical based on the long history, almost 100% strike rate of banks missing their stated cost out targets. And I think that's very difficult to do while also maintaining market share. So we're more skeptical there, but to date, the banks have held up because you've seen this rotation into the cheaper banks. And in fact, what has funded this resources rally has really been this almost bear market that you've seen in industrial stocks. You've got the consumer discretionary sector off 12% this quarter, healthcare off 10%, and then the big one has been IT, which has been absolutely smoked. The sector's off 26% in the quarter alone. There's been a couple of factors at play that's driven that. The big one over the quarter has been the fact that inflation in Australia has been running hotter than expectations. And so the market had to quickly reprice from the expectation of potentially further cuts to suddenly this realization that, oh, hang on a second, not only are we not going to get cuts, but we actually could see rate rises. And we don't, it's not clear that is going to happen. The RBA have made it very clear that they'll be very data dependent. And the data is painting a bit of a mixed story, but certainly leaning towards either rate hold or rate rises. And so for sectors like retailers, you've had this very extreme quick repricing of their prospects as you've moved from rate cuts to potentially rate rises. And that, may be throwing off some opportunities. The tech sector, I think, is where the real opportunities lie, though. A year ago, these businesses, of which we owned none, were the best business models available on the ASX, certainly by looking at their valuations. And then suddenly within one quarter, the whole sector's been smoked. And it's more than just CPI. There's a view out there, I suppose, that we don't know what AI is going to mean for these business models. And that uncertainty has just led to, the market shooting first and asking questions later. So that gets us very interested. You've got a couple of stocks. We've sort of spread our bets here with two initial positions, small positions in the fund. Both of them aren't without hairs, I suppose, but both have halved in very short order. So the first one is Xero that we've added to the portfolio. Now, Xero has more going on than just AI worries. The market is no fan of the $4 billion acquisition of payments platform in the US, Melio, that they did a few months ago. Now, we're no fans either, but I guess the opportunity here is that the market cap's fallen $10 billion, which is 2.5 times the value of the Melio acquisition. And so as newcomers to the stock, we're able to buy it at a price that we think now tilts the balance of probabilities favourably, underpinned by the value of the rest of the world business. Very strong position in ANZ, very strong position in the UK. And so you almost don't really need the US to work for there to be value in the stock right now. The other one where we've taken a very small initial position has been Life360. One of the best performing stocks up until October. They released their third quarter result. There was one figure in there that the market didn't like, which was the US monthly average user growth. And now I'm not playing that down because that is a very important figure for this business. But it's only been one quarter where they printed a number that was below expectations. So the stock has promptly halved since then. And we think that is probably too extreme a sell-off for a business that is actually performing very well across most of the P&L and the cash flow that the business is now generating. So we've taken an initial position there. And really the opportunity there is around building out an advertising revenue stream, because any advertising dollars that they can make off their freemium product, drop through with pretty much no incremental cost attached to them. So those are the opportunities that we're seeing in the tech sector right now.
Thanks, Emma. You mentioned at the very beginning that resources have ripped in the last 12 months and the last quarter. Can you talk through how you're positioned for that?
Yeah, so look, we treat resources just like any other sector. So we're really applying our investment process, which, as a reminder, is starting with the balance sheet, looking at business quality, management quality, and then finally valuation. But whenever you apply those 4 factors to any sector, there are nuances that you have to really think of when you're looking at a particular sector. And for resources, those nuances are, for the balance sheet, these are highly cyclical industries, so you really want a very pristine balance sheet, either net cash, or if it's a very diversified business like a BHP or a Rio, a little bit of debt is okay. Business quality here in resources, you define that by the quality of the resource. So where does it sit on the cost curve? Yeah. That's king. You really want tier 1 or tier 2 assets that can make money through the cycle. If you're owning tier 3, tier 4 assets, if you get the commodity price wrong, those are marginal assets that, at certain commodity prices may not make money. Yeah. And then with management, management really matters in resources. You can add a lot of value, you can destroy a lot of value. There's a lot of M&A deals in resources, and if you really want to be on the right side of those. And the other thing is, you're pulling on a pretty fixed labour pool in resources, particularly during a hot period like right now. And so you really want a management team that creates a culture that attracts talent. That's quite important as well. So management really matters. And then on valuation, typically what we've done historically is looking for situations where the commodity price is out of favour and where you're seeing cost curve support. So a point at which where not everyone on the cost curve is making money at current prices. Traditional valuation metrics don't really work in resources, because if you're looking for when stocks are cheap, that's actually not the time you want to buy resources, because when they're cheap, it's because commodity prices are usually sky high and they're actually closer to a sell at that point. So that's been our playbook in resources, and we have been very disciplined. It's pretty rare for those stars to align, but we've actually made really good money over the years in implementing this process. MinRes, for many years when we bought it was net cash. Lithium was on the nose, and that was a great performer. We sold it for balance sheet reasons last year and bought IGO. That business, talk about quality, that's the lowest cost hard rock lithium asset in the world, Greenbushes, and they own a quarter of it. So that's a really high quality asset, bought it at a time where lithium was really on the nose, and now it's come roaring back, and that business has nearly tripled over the year. And we've also owned BHP in the fund. Now, you might debate whether or not this is a resources stock, but it's probably also worth noting, because it is in the materials sector, that we've had a large position in BlueScope. BlueScope's in the news at the moment because they've had a bid come through for those assets. So that's effectively that company's in play right now. So we've been very disciplined over the years, made some good money investing with this playbook. In terms of where we're seeing opportunities right now, Rio is one that we've added to the portfolio in the December quarter. We really liked the strategy outlined by the new CEO around simplification of the assets, asset sales, and the production growth that we could see. So we added that in December. I would say that at the moment, it's very topical stock because of these talks that they're having with Glencore to create, the largest mining company in the world. We'll reserve judgment on that until we see the detail, because detail is so sparse right now. But we just note, we're no fans of large-scale M&A in the mining space, because so much of it has destroyed value. So I just would flag that. We've also re-entered Santos in the portfolio. So we had owned Santos for a number of years. We sold out on the ADNOC bid as the share price approached $8. That, I guess it's lucky that we did, because the bid ended up falling over. And now that, plus the combination of low oil prices, has seen the share price retrace to $6, and we've re-entered with a small position there. I think the other thing that's worth noting is we don't own gold, and that's really hurt us this year, because gold stocks have all ripped with the gold price. I think what we've got wrong historically in applying our framework in resources to gold is that piece around valuation. Waiting for cost curve support in gold actually doesn't work, because gold runs in really long price cycles. So if you wait until you're suddenly at a point where there are some miners that aren't making money because the gold price has fallen, you probably end up buying it way too early in a long bear market. So, gold is not driven by industrial demand. It's driven also by its perception as a store of value. Yes. And so those macro factors, currency debasement because of persistent fiscal deficits, central bank buying because no one trusts the US dollar now after the US froze Russian assets after the Ukraine war. Those macro dynamics are underpinning the gold price strength. It's very difficult to predict from here. I would just look at it and say, I think we're going to see violent rallies and violent sell-offs, and that may throw up some opportunities for us. We do own in the portfolio ALS, which is sort of a second derivative play on the gold price. Right. Half of their earnings, so it's a testing business, and half of their earnings come from commodities testing. Most of that's just driven by gold and copper exploration. Now you start to see, commodity prices rally, then the juniors raise money, and then they deploy that cash in exploration, and that leads to testing. And importantly for ALS, the testing volumes drop through at a really high incremental margin, which is sort of the opposite. For gold miners, they face a lot of cost-based inflation. And they're pretty imperfect vehicles to play a positive view on the gold price through, because you've got all this cost inflation and you've also got, it's just bloody hard gold mining. You can hit a patch of gold over here and it's not over there. There's a lot of complexity and variability in grades and variability in the ore body. And that's why you famously see production downgrades from gold producers all the time. We had one the other day from Northern Star. So that's how we're positioning gold, in the sense that we don't own the gold miners, but never say never. We might get some opportunities this year. But we do own ALS in the portfolio.
I want to turn now to a stock that's performed very well in the portfolio the last 12 months. About this time last year, you added Aspen to the portfolio. It's continued to have a strong run last quarter. It's become a bigger position in the portfolio. Where to from here?
Yeah, so Aspen, it's been the best performer for the portfolio this year. It's up nearly 1.5 times since we bought it. And we still think the outlook is really, really compelling. So we consider this as pretty much a founder-led business. The co-CEOs of the business, they didn't found it, but they effectively took it over in 2019. And since then, they've really, prior to that, it was a pretty poorly managed collection of mostly tourism assets, caravan assets. And now they've taken it over and really built this platform to deliver affordable rental accommodation in Australia. And they're really aimed at that price point of about $400 a week rental or a $400,000 outright sale. And, these are very low figures. If you look at median house prices in every capital city, there is basically no one who is able to bring stock to market at that price, let alone make great returns on it. And they've got a history of doing just that and earning, 20% plus return on their capital. So how are they able to do it? They really focus, two kind of competitive dynamics. They really focus on their purchase of land, buying land very cheaply. And that comes up through a variety of ways. But, a great example recently would be Albemarle in WA. So in Bunbury, which is just south of Perth, they had built this lithium hydroxide plant and a workers' camp attached to it. They spent $100 million building this workers' camp. And then when the lithium price was on the nose, they turned around and they said, okay, well, we're not going to expand it, so we actually don't need that workers' camp anymore. And we're just going to run the business for cash, so let's just sell it for whatever we can get. And so Aspen swoop in, buy this $100 million facility. Everything's built, like it's got like nearly 400 fully furnished sites, accommodation sites. And they bought it for $32 million. So, 30 cents on the dollar. And that would just be an example where they've just been really savvy about getting in there, buying land cheaply in great areas with a lot of growth, and where people are going to need accommodation and need cheap accommodation, and bringing stock to market to meet that demand. So it's a large position in the portfolio today, and it's come through the performance. And, we still think the outlook is incredibly compelling. It's got a great 5, maybe even 10 years ahead of it. And so we're very happy holders of that one.
I noted earlier you talked a lot about some opportunities and some ideas that you've got in the portfolio. How are you funding those?
Yes, so there's been a couple of stocks that have had good runs that we've just taken a bit off the table. So the two there that I'd call out would be Charter Hall. No change to our thesis, but it's gone from $8 to $25, as everyone's figured out. Office isn't dead forever. And the other one would be Ampol. Business is going exceptionally well, but refiner margins have gone from very low to very high. So taking a little bit off the table there, as the share price has gone from $20 to over 30. And then the other one that's probably worth talking about that we have used as a funding source for different reasons, unfortunately not because of success, but instead because of a change of view in the light of failure, would be CSL. CSL, I have gotten this stock phenomenally wrong this year. I had thought, 70% of their earnings are driven by the plasma business. And I knew the outlook was bad. I knew that the outlook for V4 was a fizzer, but I genuinely felt that the bulk of the business, which is the plasma business, had a good outlook, and then that there was a lot of cost out opportunity as well. And funnily enough, I suppose I got the cost out opportunity right, but what was disappointing that we found out at the result was that they needed the cost out to offset some of the margin headwinds in the plasma business that I hadn't foreseen. And the plasma business is very difficult to forecast because there's basically all these pockets of margin, and you don't really know where they are until suddenly you find out that they've disappeared. That's kind of been the frustrating story of the last few years. And so where I've landed today, I've really, gone through every assumption with a fine-tooth comb to really understand like what our conviction rests on. And there's been a few takeaways from that. The first thing is I find it very difficult to get a valuation that is dramatically below the current share price. So I think a lot of bad news is priced in. So I suppose that's the good news. That's why we still own in the portfolio. But equally, my own confidence in the forecastability of this business has gone down massively. I mean, if management find it difficult to forecast, they gave us guidance at the full year and then they downgraded a few months later at the AGM. If they can't forecast the business, it's very difficult for an outsider to do it with any degree of certainty. And then I look at some of these pockets of the bearing business in particular, where the outlook looks quite challenged. Albumin would be one worth calling out that drove part of the AGM downgrade. They sell 60% of their albumin into China, and China has this insatiable demand for albumin. But the CCP have looked across China for where they're reliant on imports for anything, and they want to be self-sufficient. And the top selling drug in hospitals is albumin. So they don't like the fact that they are importing nearly 70% of their albumin. So they're trying to change things. And part of that is demand constrained measures. Part of it is trying to boost domestic supply. Either way, I think over the long arc of history, the CCP tend to get what they want. And so I think the albumin outlook in China is now quite challenged for CSL. So they need to find a home elsewhere, and that's going to lead to pricing pressure. So it's little things like that where I think the outlook, when you're looking at any stock, and you've gotten it wrong, as we have here, you can either lean into the fear and add and say, no, the market's wrong and now I can buy this business lower, or the facts have genuinely changed and the upside is genuinely diminished. And I'm not entirely sure where on the spectrum CSL sits, but I've had to reflect that uncertainty in our position sizing. So it's a long-winded way of saying we're still there, still overweight, but we have reduced the position.
Great. Thanks, Emma, for those insights and that update. And thanks very much for watching. If you'd like further information around the Airlie Australian Share Fund, please visit our website.